Today we are going to talk about the cost of capital and the hurdle rates. And this is commonly called the threshold that every investment in a company must clear. And it's one of the most foundational concepts in corporate finance, the cost of capital. And it is a single number, or more precisely, this carefully constructed estimate. It serves as a benchmark against which every investment, every project, and every strategic initiative must be measured. And understanding it deeply is essential for any financial leader who wants to create rather than destroy value. So let me begin with the core idea. Capital is not free. Whether you borrow money from lenders or raise it from shareholders, that capital has cost. And lenders, they expect interest. Shareholders, they expect returns, and the cost of capital represents the minimum return your company must earn on its investment to satisfy these expectations. So if you consistently earn returns below your cost of capital, you are destroying value. You are taking money from the investors and converting it into something worth less than what they gave you. Think of it this way. Your investors are both, they are lenders and they are shareholders. And they have alternatives for their money. They could invest in government bonds. They could invest in other companies and in real estate and countless other opportunities. And to attract and retain the capital, you must offer returns that compensate them appropriately for the risks that they are taking. So, your cost of capital is a return that makes those investors willing to entrust their money to your company rather than pursuing those other alternatives that they have. And the most common framework for calculating the cost of capital is the weighted average cost of capital, universally known by its abbreviation, what? Weighted average cost of capital, or WACC, WACC. The concept is straightforward. Since most companies are financed with a mix of debt and equity, the overall cost of capital is nothing but a blend of the cost of each component, weighted by how much of each the company uses. So let me walk you through this conceptually without getting lost in formulas. Suppose your company is financed with 60% equity and 40% debt. Well, the cost of your equity is the return that the shareholders are expecting. Let's say it's 12%. And the cost of your debt, the interest rate that you pay is 6%. But debt has a special feature. Remember that interest is tax deductible. And if your tax rate is 25% and the after-tax cost of debt is not 6%, but let's say rather 4 or 4.5%, because the tax savings actually effectively reduce what you're paying, right? So to find the weighted average, what you're doing is you're simply multiplying each cost by its weight and then adding them together. So 60% times 12% equals what? 7.2, and 40% times 4.5 equals 1.8, and there you go. Add those together and you get 9%. Well, that is your WACC, your weighted average cost of capital, the blended return you must earn to satisfy all your capital providers. Now, the change lies in determining the inputs to this calculation, and the cost of debt is relatively straightforward. It is the interest rate you pay on your borrowings adjusted for taxes. You can observe it directly in your loan agreements and bond yields. But the cost of equity is more elusive because shareholders, they do not receive a contractual return the way that the lenders do. And the most widely used approach for estimating the cost of equity is called the capital asset pricing model. Without delving into the mathematics, the intuition is this. Investors expect to be compensated, and they expect to be compensated for two things. First, they expect compensation for the time value of money, the return they could earn on a risk-free investment like government bonds. Second, they expect additional compensation for bearing the risk of investing in your company rather than that risk-free alternative. So the risk premium, it depends on two factors. How risky is the overall stock market compared to the risk-free investments, and how risky your specific company is compared to the market. A company whose stock is moving more dramatically than the market, rising higher in good times and falling further in bad times, they are considered riskier, higher beta. That's what a sign for risk is. And it commands a higher expected return. A company, however, on the other hand, whose stock is more stable, it commands a lower expected return. And it is this sensitivity to market movements, and like I said, is captured by beta. A beta of 1 basically means that your stock is moving in line with the market. A beta greater than 1, it means that you're more volatile than the market. And a beta less than 1, it means that you're less volatile. So companies in stable industries like utilities, they tend to have very low betas. Companies in very cyclical or high growth industries, they tend to have very high betas. And I want to be candid about the limitations of these approaches. Calculating the cost of capital, it involves substantial estimation and judgment. The risk-free rate changes with market conditions. Now the beta estimates, they vary depending on the time period and the method used. And the expected market risk premium, which is consistently the subject of ongoing academic debate, reasonable people can arrive at meaningfully different estimates of cost of capital for the same company. And it is this uncertainty that not necessarily, it doesn't make the cost of capital useless. Far from it, it simply means that we should view it as an informed estimate rather than a precise measurement. And the goal is to be approximately right rather than precisely wrong. And a company that ignores the cost of capital entirely is making a far greater error than the one that uses an imperfect estimate. So yes, there's a value. There's a value to that WACC calculation. Now let me now turn to how cost of capital is applied in practice through hurdle rates. And a hurdle rate is a minimum acceptable return for an investment. And for many companies, the hurdle rate is simply the cost of capital. Investments must return at least enough to satisfy the capital providers. And if a project is expected to return 8% and your cost of capital is 9%, the project ought to be technically rejected. It does not clear that hurdle rate. However, what happens is that many companies, they set hurdle rates above their cost of capital. They want to have the cushion, the margin of safety. And there are several reasons for this. First is the projections are often optimistic, and requiring returns above the cost of capital helps ensure that even if results are disappointing, the value is not destroyed. Second, it creates selectivity when capital is limited. If you have more good opportunities than you have capital to fund, the higher hurdle rates will help you choose the best among them. And third, it accounts for implementation risk. And it also accounts for the organizational cost of pursuing those new initiatives. The practice of risk-adjusted hurdle rates takes us even further. Not all investments carry the same risk, and apply a single hurdle rate to all of them can lead to poor decisions. A routine equipment replacement in your core business is a lot less risky than entering a new market or developing an unproven technology. And using the same hurdle rate for both penalizes the safe investment while being too lenient on the risky one. So risk-adjusted hurdle rates assign higher required returns to riskier projects and lower required returns to safer ones. And the logic is sound. Investors, they expect higher returns for bearing more risk. An expansion in your existing market might need to clear 10%. A venture into an adjacent market might need to clear 15%. And now a speculative bet on a transformative technology might need to clear 25% or more. So implementing risk-adjusted hurdle rates require judgments about how to categorize investments and at what premium to apply for in those different risk levels. And some companies, they develop formal risk classification frameworks. And then there are others that rely on management judgment, and those are applied case by case. So the important thing is to explicitly consider risk rather than treating all investments as equal. Let me discuss capital allocation, because the cost of capital and the hurdle rates are ultimately tools in service of this larger objective. Capital allocation is a process of deciding where to deploy your company's financial resources, which projects to fund, which businesses to invest in, which initiatives to pursue. And a good capital allocation, it creates enormous value. It creates enormous value over time. A company that consistently directs capital towards its highest return opportunities compounds the advantage year after year. And poor capital allocation, it destroys value just as surely money invested in subpar projects is money that that could have been returned to shareholders or deployed more productively elsewhere. The discipline of comparing expected returns to hurdle rates is central to good capital allocation, but it must be applied, and it must be applied thoughtfully. There are some considerations that complicate pure return-based analysis, and they deserve a mention in this particular session. Strategic optionality is one such consideration. What does that mean? Some investments, they may not clear hurdle rates on their own, but they create options for future valuable investments. So in other words, you are entering a new market at a loss might be justified if it positions you to capture major opportunities later. You're looking at R&D, your research and development spending rarely clears traditional hurdle rates, but may be essential for long-term competitiveness. Now, the challenge is distinguishing genuine strategic investments from poorly conceived projects dressed up in strategic language. Maintaining that competitive position is another consideration. Sometimes you must invest simply to stay in the game. And if competitors are upgrading their facilities or they're upgrading their capabilities, standing still may not be a viable option. The return on such investments should be measured not against doing nothing, but against the consequences of falling behind. Estimation uncertainty affects how we should interpret return projections. A project with a projected return of 12% and high uncertainty is very different from one with the same projected return and high confidence. Now, there are some companies that are addressing this by requiring higher returns for more uncertain projections. Others use scenario analysis to understand the range of possible outcomes. So I want to address a very common dysfunction in capital allocation. The tendency for projections to be reverse engineered to clear whatever hurdle rate is required. And when the proponents of a project, they know that they need 15% returns to get the approval, there is a very strong temptation at that point to construct those assumptions that produce exactly that outcome. So the numbers, what happens? It becomes a negotiation, right? Rather than an honest assessment. And combating this requires a culture of intellectual honesty and accountability. Assumptions, it should be scrutinized, it should be stress tested. Projection should be compared to historical results from similar investments. Post-investment reviews should actually track actual performance against projections with consequences for systematic overpromising. The goal is not to punish failure. Many good investments will disappoint. That's a reality. But the goal is to discourage the gaming that undermines good capital allocation. Let me conclude with a broader perspective on cost of capital and value creation. And what would that be? The companies that create the most value over time are those that earn returns substantially above their cost of capital and do so consistently. And they have found business models, they have found competitive advantages, and they have deployed operational capabilities that allow them to generate those excess returns beyond what the investors are requiring. And so the role of the CFO is in this value creation process, and that is multifaceted. You must ensure that the cost of capital is calculated rigorously and updated as circumstances are changing. You must establish appropriate hurdle rates that reflect the risk and maintain the discipline. And you must build the capital allocation processes that direct resources toward the best opportunities. And finally, you must create a culture where honest assessment of returns is valued over advocacy of pet projects. So, cost of capital is not just a technical calculation. It is a bridge. It's a bridge between financial markets and operational decisions. And it translates the investor expectations into actionable criteria that guide how a company deploys its resources. Master this bridge, and you hold one of the most powerful levers for creating long-term value. I want to thank you for your attention. If you have any questions, comments, please drop a note on the comment box and I'll respond as soon as I can. I hope this is helpful to you, and if you have any pointers, I would like to learn a lot from you, and I'll be happy to call you out in future sessions if some of your points are incredibly valuable for the rest of the viewers. So thank you again. Take care. Bye-bye.